Hello, everyone, and thank you for joining us for this meeting. We know that your schedule is incredibly busy, so thank you for taking out this time. This meeting is being recorded, so if you are not able to stay for the whole thing, or you know that someone else may be interested, this will be posted in a few days so that people can still catch this information. Just to give everyone the update on procedures for what we're doing. I'm going to ask everyone, if you are not actually speaking, please mute your microphone. And if you turn off your camera, it takes a little less from the bandwidth, so it's a little bit less stress on the system. And adjust your view to your preference. You can either look at the speaker view where you're just seeing the slides and whoever is actually talking at the time, or the gallery view where you get to see more of the participants. Be sure you adjust your volume. And I'm going to ask, if you look at the ribbon that has the options on it, you can click on chat, and there'll be a spot at the bottom there for you to type in any questions or comments that you may have. I will ask you to hold your questions until we get to the end of a section, and then we'll answer questions from the chat. Or you can also go to that same ribbon and click on the reactions. Excuse me, mine doesn't have the same options because of the hosting position, but you will be able to raise your hand and hit that feature and speak to the presenters. As I said, this session is being recorded. And my first question goes out, is Diane here yet?
Hi, Jake. Hi, Jake. Yes, I am.
Hi. Oh, great. Great. I understand. Oh, and this is brought to you by the University of Vermont's Agricultural Risk Management and Crop Insurance Education Program. That's an older picture. That's what happens to hair like this when you go feral during a pandemic. I want to introduce Diane Bothfeld, who comes to us from the Vermont Agency of Agriculture, Food and Markets. And she's going to give us a quick update on some programming that is of interest to our Vermont dairy producers. I'm going to stop sharing, Diane, and give you the floor.
All right. Thank you very much, Jake. And I'm glad that you're putting on this webinar today. I think it'll be useful for the folks that are taking part. So thank you very much.
Thank you.
During the legislative session, the legislators put forth $2.6 million to reimburse dairy farmers for their participation in the USDA Dairy Margin Coverage Program. That's a program where dairy farmers have to pay a premium to take part, and they can select many different coverage options. The payment would be only on tier 1 production, so up to 5 million pounds, and the maximum level of premium would be 15 cents per hundredweight. So the potential of 7,500 as the maximum amount, but then it is a reimbursement program, so it'd be specific to only what a farmer paid in. So being a reimbursement program, farmers will need that receipt from USDA of what have they paid. The Dairy Margin Coverage Program is unique that it does allow people to wait before paying their premium in full. They have until September to do so. In some years, if there's a payment from the program, it may take care of the premium in that manner. So far this year, there haven't been any payments. So we will, at the state, to do the reimbursement, we'll need to know that the dairy farmer has paid USDA in full. So it's a matching program. If you paid $1,000, you only get $1,000 back from the state of Vermont. We are working on the application process now. It is from federal dollars, so there's a bunch of hoops to jump through. We're working on that and expect to have the applications out in June for farmers to apply and to be able to get this money after they've paid USDA in full. So that's the overview of the program. It's fairly simple, but the use of federal dollars makes it several hoops for the state to jump through before we can do the application process. So we're getting there. Hope to have those applications out in June. And Jake, that's the basic overview.
Great, Diane, that's really helpful. If people need more information on that, who do they contact? Do they just get in touch with your office directly?
Yep, they can get in touch with me, diane.bothfeld@vermont.gov. You can certainly send me an email. Reaching me by phone's a little tougher, so email's best, but glad to answer any questions, and hopefully we'll be able to launch that program soon.
Great, that's very useful information. Thank you. We appreciate you stopping in. I know you are certainly welcome to stay as long as you can. I also know you have some other obligations.
I do. Thank you very much, and hope the rest of the webinar goes well.
Thank you. Well, I'd like to move on and introduce Nathan Peabody, who joins us from Agrimark. He is one of their dairy economists and probably has a better finger on the pulse of what's going on with milk pricing and what the dairy market is going to be looking like in the future. I don't know if he has a crystal ball or if he just knows things. I'm sorry, not getting through my slides well.
Was I preemptive in sharing my screen on you?
I don't dueling slides.
Oh, I apologize. Would you like to put yours back up?
No, you're fine. Go right
Okay.
ahead.
Great. Well, thank you very much for the invite. Again, my name is Nathan Peabody. I'm an Agrimark economist. I'm hoping that I can bring some value to this conversation. I do not have a crystal ball, unfortunately, but you know, I do follow the markets on a daily basis. I am Agrimark's author of our milk price forecast. So I'm going to go over some of the major market movers and things we're watching as the year progresses, and just go over a few slides and basically some supply and demand data. And there's really two major factors at work right now. The first is global supply. Global milk supply has been down for much of the year, including the end of last year. And that's really driven prices to where they are today. But in recent weeks and months, we've started to see that dairy demand is starting to have some challenges. And I'm also going to go over some of that data as well. And really the main takeaway is that when we're looking at a milk price outlook, volatility is still very much in the marketplace. And there is still some uncertainty about where prices will go. So hopefully you guys will have a better understanding and an idea of where I'm coming from with that statement as we go through the slide deck. So first I'm going to start with milk production. Again, I just mentioned that a minute ago. In the US, milk production has been either at or near zero or below 0% growth since August of last year. So that's about 8 months. And in our March data is our most recent data, and that was at a negative 0.5%, so lower than we were last year. If you look internationally, our major export competitors, the largest dairy producers globally outside of the US are Oceania in Europe. Oceania is New Zealand and Australia. And again, they're in a very similar position. They have seen negative growth since right around the same time last year. So there has been a less supply than usual on the global and domestic dairy marketplace. And that's really what's been driving prices to these highs that we've seen this spring. Now, in recent months, that milk production growth has started to edge closer to zero. And if you look regionally, you'll see that in March, the two largest areas of milk production in the United States, that would be the Midwest and California, both went positive. So that to me is a sign that we are starting to get back into closer to a 0% growth rate. And my expectation going forward is that we will see growth of milk increase in the second half of the year. And the main reason I say that is because the major driver of milk production declines over the last 6 months has been dairy herd. Last summer, our dairy herd was at the largest it's been this century. And then we had a pretty steep fall off as prices weren't really able to support that size of a dairy herd. Now, in recent months, we've seen prices come up, and we've also started to see the dairy herd size increase. So as we go forward, we'll be watching the dairy herd numbers on a monthly basis as an indicator of where our milk production is going to go into the future. Now, before I switch to the next slide, I just want to also mention that last week, the USDA had their World Agriculture Supply Demand Report, the WASDE report, and in there, they estimated that milk production would reach 1.3% by Q4 this year. So I think that's a pretty good estimate. Might be a little higher, but I think 1.5 is right around where I would say I would expect milk production to be. Again, that's a long way off, and that response can vary, but the market is anticipating a milk production increase, but just maybe not as high as we would have seen in other times in history when we saw prices that were at this level. And the reason why that milk production increase may be muted or less so than what we've seen in the past is the on-farm margins, or we could call this dairy inflation. There are a number of factors that are leading prices on the farm to really be higher than they have ever been in the past. Most notably, everyone sees fuel prices, and on the farm, diesel, natural gas prices, electricity, all that are up on last year. And then also there's feed. Now, feed prices have been sky high this spring. In the US, we've seen that there's an expectation of less acreages being planted for corn. That, along with the war in Ukraine, with Ukraine being a large corn exporter, those two things together have really pushed corn prices to highs that we don't typically see. July futures for corn are at $8 right now, and the remainder of the year into July 2023, corn futures on the CME are $7. So those are very, very high prices. And again, that's going to limit the amount of milk production growth that's possible. And as I'm looking forward into the next year or 2 years, when I'm doing a milk price forecast, understanding or estimating where that milk production number will be is really the most important factor in determining what prices are. And as long as we see fuel and fertilizer and feed prices at this level, we should expect that it will be challenging for milk production to increase at levels that we've seen in the past. The one other thing I'm going to mention also is processing capacity and interest rates. Processing capacity has been challenged in the last year with labor shortages and supply chain issues, and those issues continue. And when there's processing capacity, there is less ability to produce milk. And the last one is interest rates. Interest rates are a challenge when you're trying to expand either on farm production or production for a processor. So that will, again, limit or make it more difficult to expand growth on both levels and limit milk production. Now I'm going to quickly switch to the demand side of the equation. We've all heard about consumer price index, or the inflation in the US and around the world is at levels we haven't seen in 40 years. In April, the general inflation rate was at 8.3%, which is basically, it's a tiny bit lower than what it was in March, but still a high we haven't seen in 40 years. And dairy is no exception when it comes to inflation. Dairy's at about 9%, which is slightly higher than the general average and slightly lower than what food is right now. So dairy is right in the thick of it when it comes to inflation. And what that means for our demand is that our consumers have less purchasing power. When they're going to the grocery store or when they're going to the restaurant, it is more difficult or it is more expensive to buy product, which means they're less likely to do so. And we've started to see the impacts of inflation, both domestically and internationally, on our demand portfolio in the beginning of this year. We saw that on the domestic side, butter was really struggled in the first quarter of this year. And on the export side, dry whey and skim both also struggled. Now, I want to just also take everyone's eyes to the graphic on the left, the bar graph, the demand, domestic versus export. This is an important slide that I like to bring up when we're talking about demand numbers, because as an economist, I love to throw around numbers about what our growth rate for exports were, because exports have become so important for our industry. but a percentage growth for each category isn't exactly equal. They're not made equal. For instance, if you look at butter and cheese, you see that it's mostly a blue graphic. And that means the domestic portfolio, or the amount of product that's consumed that's made in the US, is mostly about 94% from our domestic market, which means if we see something like butter exports up 41%, well, that's certainly a positive. It isn't necessarily going to change the demand outlook when you consider that on the domestic side, we had a negative 7%, which far outweighs that export. Now, on the flip side of that, we have the dry commodities, where they're mostly an export portfolio. So a decline in exports for those products have a much larger impact on what the prices for milk are. So when we're looking at, say, non-fat and skim down 8%, that's a pretty big decline on a year, and that will certainly have an impact on what milk prices look like. Now, again, I just talked about what sort of the ratio of export versus domestic are, and I want to point out what our most recent export data was for March of this year. This came out about 2 weeks ago, and it was actually a very, very strong month for exports. Now, you'll see that non-fat and skim is the one product of the pricing product that was negative. And the reason for that is that March of 2021 was actually the strongest March export we've ever seen. Now, that historically high number makes this year's exports look bad at negative 7%. I would love to see it at 0 or growth, but actually this March was the second highest March export for non-fat that we've ever seen, which means it was still a strong month, but just wasn't as strong as last year. Now, the other three pricing commodities were great. Cheese up 13%, butterfat up 60%, and even whey was positive despite declines from Chinese purchases. Now, the most important thing on this graphic is if you look at the total value column. Total value up 25% is a great sign. And I'm very excited to see that as an economist, because as the US exports more cheese and butterfat, those are higher value products. And that means there's more money coming into the country from overseas than if you were just having exports of dry commodities. So that's a really great sign. Cheese has been very strong in exports through the last 6 months, and we're hoping to see that continue as global supply of milk continues to be lower and there's more product available in the US to ship overseas. Now, I've talked for about 11 minutes, and I know I'm trying to shoot for between 15 and 20. So I'm going to try to go for these last few slides pretty quickly. I'm just going to look at each of our pricing commodities in a little more detail. So first, we're going to start with cheese. The spot price of cheese right now on the Chicago Mercantile Exchange is about $2.40. And I had just spoke about how demand has been strong in the first quarter of the year for cheese. And we can really see what that effect is on the spot price if you look on our graphic to the left. From February to March, we saw an increase from the $1.80 range to the $2.40 range. That's about 60 cents. And a lot of that can be attributed to strong demand. You can also attribute that to some supply challenges with logistics and things like that. But mostly I can attribute that to demand. Now, if we look on the right, we see the cash settled cheese futures. Those suggest that prices are going to peak right around now and come down throughout the rest of the year and into 2023. The main reason for that is an expectation of 5% growth rate for demand is probably strong. We probably won't see the same level of demand increase, even if demand stays positive for the rest of the year. And also that expected milk supply response will also have an effect on cheese markets if that production ends up increasing over time. Now, I want to put one graphic for each of these commodities. I usually have a few when I do this, but for the sake of time, I picked one that I think can speak the best for what is influencing the commodity markets as right now. So for cheese, I picked cold storage, or our total number of cheese stocks. This is a very important slide and is the largest indicator of spot price. This is the number one variable that indicates spot price over time, is how much storage we have, because that's essentially an estimate of how much supply there is on the marketplace. And in March, we saw that storage number actually went negative for the year, which is pretty uncommon. And the reason for that is, again, that strong demand we saw, and then also some supply challenges. So put together, we have less supply than we were expecting earlier in the year, and that's why prices have gone up. Now let's switch to dry whey, the other class 3 pricing commodity. Now this is a spot graphic that goes back to 2018. So we have a much longer period of time than what we were looking at with cheese. And the reason why I wanted to do that is that there's pretty clear division between what happened between 2018 and 2019, and then 2020 and 21. 2020, 21, we have much higher prices. So the question is, why has that happened? And then why have we seen a really large decline in the last month to kind of get us back down to where, right in the middle between those two periods? There's actually a pretty easy explanation for that. And that is Chinese imports of whey products from the US. Now, from August 2020 to December 2021, over that about 18-month period, cheese imports to China, or sorry, not cheese, whey imports to China went up by over 50%. Now that there's a number of reasons for that. One of them is that the Chinese hog industry was rebuilding their population, rebuilding their herd. And so they had much more demand for feed for their animals. Now, what's happened in the last couple of months is that cheese imports have gone down quite a bit to China. And that's for a number of reasons, again. But one of them is that the lockdowns in China have really decreased the amount of demand that we've seen in that country for all dairy commodities. So that's really the big reason why we've seen such a large drop in price from that 80 to 90 cent range that we were a couple months ago to where we are now around 50. As we go forward, the export portfolio specifically to China will be very important to determining what the price will be. Now let's switch to butter. Butter has had a pretty solid year, but for the last few months, we've been really range bound between these two red lines here on the left graphic between $2.80 and $2.60. And as we look into the futures market, again, suggesting highest prices now, slowly decreasing over time. Again, struggling demand is one reason why prices are expected to decline, and then also that production response that we expect in the second half of the year and into 23. The one butter fundamental slide I wanted to bring up was butter production. We got a report 2 weeks ago on what March production was for butter, and it was at 1.5% growth rate, which isn't a very large growth rate, but if you consider where growth has been the last 6 to 8 months, this is actually only the second time we've seen positive growth for butter year over year since June of 2021, which to me means that butter production is starting to increase. There should be more supply, and if demand is lagging, then maybe we should expect a response from butter and with the prices softening a bit. Now, finally, our last commodity is non-fat dry milk. This is again a class 4 pricing commodity. Non-fat has had a phenomenal 18 months. It's really, the price has gone up like clockwork for over a year. And we reached a peak of around $1.90 in February. Since then, we have seen the price come down a bit. We're right now in the 170s. And the reason for that is declining export demand, as we talked about a little earlier. While we still have strong export demand, it's not quite strong enough to support $1.90 prices. But $1.70 is still very supportive of class 4 price. And if we look historically, that's still very, very strong for a non-fat price in the US. Now, we talked about demand. The other thing to mention with non-fat is the supply side. If we look at this graphic on the right, we've had negative supply growth for non-fat for a number of months now. Non-fat is typically a balancing mechanism. So in a lot of times, if there's limited milk supply, there'll be limited non-fat and skim production as well. And that goes for a global marketplace as well. There isn't a whole lot of skim, or there's less skim being produced in Europe and New Zealand than there typically will be, which means even if export demand, if total demand for non-fat around the world is lower, we should still expect supportive exports for the US because we'll actually have more product available than some of our other competitors. So with that, I'm going to just go into my summary slide here. On the left, I have a graphic of what my milk price forecast was from May 13th with the blend price in blue, and then the class 4 in green and class 3 in gray. And you can see that class 3 and 4 are expected to stay pretty much equal with each other. even though class 4 has been leading the way for the last 6 months with higher prices. As we see more milk production come online, I expect that to have a higher impact on class 4 than class 3. So when I'm making my forecast, that's really what is determining the difference between these two classes. Now, what the farmer really cares about is the blend price. And the blend price is forecast to be around $26 for this time of year, and then slowly go down to the low 20s through 2023. Now, that looks really great. $20 to $22 blend prices are still very strong, but keep in mind what we talked about earlier with the on-farm margins, the corn, the feed prices, all of that. And also, there is still a great deal of volatility on the marketplace. Global supply is low right now, but there is always the potential for supply to increase. There's always the potential for domestic supply to grow at a higher rate than we expect. And then there's also the supply chain issues, the port congestion, the labor markets. All of those also add a great deal of uncertainty to what milk production will look like, and then eventually, and also what demand will look like. With inflation and macroeconomic crises around the world with our export partners, demand is also a challenge to forecast right now. So all of that being said, my main takeaway is prices look strong, but we also want to consider that now would be a great time to look at doing some risk management, whatever program works for you. There are some good prices out there that you can hedge with. So with that, I'm going to end my presentation. I would love to take any questions now or at the end, whatever you guys prefer. But thank you very much for the time.
Thanks so much, Nathan. This is great information. And hopefully people will take that into account. I think one of the big takeaways is that you have to temper any exuberance about a strong milk price against the costs that farmers are also bearing right now for their corn and other grains, and certainly for their fuel and other overhead expenses.
Couldn't agree more.
It's a scary time, but one thing we know for sure about New England producers is they're incredibly smart and resilient. So I agree with you that now is a good time to take a look at some of the risk management options that are out there. Taking a look in the chat, I do not see any questions at the moment. And certainly if anybody has a question, you can just click on that reaction button and raise your hand, unmute yourself and ask a question before we move on to the next section. There is one question here for you. How far out would you suggest farmers lock in milk prices?
Well, that's a really good question. And I am not a risk management expert, so I won't say exactly when you should or shouldn't. What I will say is when I look at the futures market and when I look at my forecast, I think the class 4 futures right now are pretty favorable, because if we do see a milk production response, and if it is a little bit higher than what the industry is forecasting right now, I think that's going to have a larger impact on class 4 than class 3, because what we've seen in the last year, where class 3 has seen some large cheese production increases, specifically in the Midwest, and that's drawn a lot of milk out of butter production. And that's one of the reasons why we were in a situation where there was concerns about potentially having a butter shortage at one point or earlier in the year. So as we see more milk production come in, I think that's going to have a larger impact on skim and butter, which I think would be nice to look at class 4 right now and manage some risk against that potential. But I'll leave the rest of the analysis on specific program stuff for our next speakers.
Rachel, did that answer your question? And certainly anybody, okay, thanks. But you can unmute if you have a question that you would rather ask Nathan directly instead of putting it in the chat. Great. Thank you so much. I really appreciate the feedback. Um, Nathan, are you going to be sticking around? Because we're going to have some opportunity for some questions when we get to the end of the program as well.
I will be around for questions at the end.
Great. Thanks so much. Well, then with that, I'm going to introduce our next presenter. We're going to talk a little bit about some very specific risk management options for you. If I can, if I can maneuver my way back into the slides. Thank you for your patience, everybody. Apologize for the delay. I know over this time we've gotten better, but for me, it's not all smooth sailing necessarily. Okay, I'll move ahead to William Barnes, who is the Deputy Director of the RMA Raleigh Regional Office. That is our nearest RMA office. And he's going to talk to you a little bit about the Dairy Revenue Protection Program. My sense is that this might be a good time for you to take another look at it if you have not considered this program before. Welcome, Will, and I'm going to turn this over to you so you can pop your slides on when you're ready.
Well, thank you very much. I hope y'all can see my screen. Hopefully it showed up now.
Yes.
All right, good deal. Like I said, I'm Will Barnes. I'm the Deputy Director of the Raleigh Regional Office for the Risk Management Agency. I apologize that we are the closest office. We cover 14 states between North Carolina and Maine. And with only 11 of us, we've got a lot of ground to cover. I hope to get up there as soon as I can and actually be out in the actual field again, the way work is supposed to be. But so I'm here today to talk to you about a handful of RMA programs or coverages that you might have. Dairy revenue protection, which is already utilized in Vermont. I'll show some statistics about that, as well as a very, very brief overview on livestock gross margin and whole farm revenue protection, which are also available. We did previously have a livestock revenue protection for dairy. That no longer exists for dairy. So we will move along, and hopefully that is transitioning. And just a disclaimer, the most important line here is the underline line. I assume we will send this slide deck out for everybody to view at any time. Material does change year to year. Dates occasionally change, and obviously prices and calculations can change. So use it to the best of your education ability, but make sure that it's still correct if it's not this year. These products are privately owned, so the United States government and the USDA does not own it. It just operates it and subsidizes it. They are all owned by a private owner. That's part of the reason they're available in all counties in all 50 states, especially DRP, which will be the primary topic. They're submitted under the 508H program, which is what private submitters do to create crop insurance. So like I said, we'll go through DRP. That covers only grade A milk. And it must be bovine milk. We don't have any goat coverages or anything like that, so my apologies there. Currently, there is no organic option for it as well. I don't know if, I'm sure y'all do have organic dairies. I do not know if there are any grade B dairies anymore, like prison dairies, which I'm always interested just to find out. And we, like I said, briefly cover LGM dairy and a little bit of whole farm revenue. Now, whole farm revenue, if you did have goats, that would be potentially an option. So DRP was developed about 4 years ago now, as long as I've been with RMA. That was one of my first trainings in Kansas City. It's an area-based revenue insurance product, specifically for cattle, dairymen, dairy producers. It protects against both price and yield, the combination to create the revenue decline. It's sold in quarterly coverages for up to 5 quarters. So you can be out a year and a half, almost, well, a year and a quarter in front of you, which there's some pluses and minuses too, obviously. And you can decide between 2 pricing options, either class price, which is just class 3 and class 4 combined, however you would like to divide it, or component pricing option, which takes a combination of butterfat, protein, milk, and other solids. Vermont is one of the lucky states. There's about 20 in the country that have their own production pool. Vermont is one state that operates entirely on its own production. So when the calculation of yields comes, that is Vermont milk per cow yield, and not almost every other state. New York has its own as well. Every other state in the Northeast uses a pooled Northeast region, but Vermont is the production is significant enough to it's a per cow yield for Vermont only. There's not a lot of coverage declarations. It's a fairly easy program to use. Not many reporting requirements outside of signing up, booking your prices, booking your coverages, and then supplying your milk tickets if there's a shortfall. The premiums are established using actuarially appropriate methods. It's a CME. Operates on the same area-based revenue protection subsidy schedule of area programs. As you can see, that the subsidy that the government will provide goes down as your coverage goes up. You may not book below 70% coverage. That's there is no catastrophic level for this program. No 50% and 55% coverages. So, but the government would prefer that people get as much protection as possible if they feel they need it. So we'll go through what a quarterly coverage endorsement is. You would fill out an application, and then you would actually select a quarterly coverage for what quarters of milk you want to cover. We'll get to the table on that in a minute. They're all 3 months. It takes the price average of those 3 months as estimated by the CME. To establish this coverage, you just need the value of the milk. That books in the price. The total amount of milk doesn't have to be all your milk on the farm. If you want to dip your toes in it, could just be a couple of 100,000 pounds on the quarter, could be 1 million pounds. It depends on the size of your dairy, your risk aversion, and other things. The level from 70 to 95% of that milk. And then, yes, your share. If it's a sole proprietorship, it'd be 100%. If it's a partnership, maybe 50-50. If you're already incorporated, then it would be 100% to the corporation, and so forth. And a protection factor, which can potentially bump up your prices and increase your likelihood of getting a payment. So producers, dairymen would have a chance between, which is odd, and this is part of one of the small flaws in the system. At about 4 o'clock each day until 9 a.m. the next morning. So when crop insurance agents are working, DRP is at the end of the day. Is when you would be filling out your application and booking your quarterly coverage. But that's when the prices are locked in. We don't really have a choice. So you would figure out the price that you like based on watching the markets as best you can. And then if the prices look very high and you don't think that's sustainable, let's say, then perhaps you want to take out coverage then. right now, you have to purchase prior to. So we are in, what day is it today? The 17th, 5/17. So right now you could buy 804, 805, 806, 807, and 808. Those are the quarters you can buy. Because it's 50, yeah, sales close 15 days before the start month of whenever you plan to book the quarter, and so forth and so on. But this is, if y'all can see my mouse, that's where we're at right now. Now, you might say, why would you want to book all the way till next July? I would leave that up to the economists. I have not, and I only studied it briefly in school. I studied poultry. Okay. As I said, the price is based entirely on the CME Group, Chicago Mercantile Exchange, I should say. It takes the booking price, average quarters for the monthly price, and creates that quarter. So in this scenario, you can tell this was made last year of 825, 850, and 875. That average would be 850, and that would be your locked in expected price. Excuse me. Oh, I'm out of water. And then at that point, you would decide on a weighted average. You can do 100% class 3 or 100% class 4 or any 5% increment in between. And like I said, if you wanted to create multiple quarterly endorsements, that's okay. If you wanted to do 100,000 pounds at 100% class 3 and 100,000 pounds at 100% class 4, that's fine. It just can't be the same milk. But so long as you've got enough milk to cover all of it, that's okay. This is the most basic. If class 3 is expected to be 17.25 and class 4 is 16 1/4, this particular example, they just chose 50/50, which breaks down the price and then locks in the total calculated class price per 100 of 16 3/4. Now, component pricing option, if you are maybe more into a Jersey herd or like a brown Swiss, you have a very high butterfat test. There's some pluses and minuses to maybe choosing. Well, I don't know much minuses. I don't know many pluses either. The component pricing option, which is based entirely on butterfat and protein test pounds, you would declare your butterfat test. Can be no less than 3 1/4 pounds and no more than 5 1/2. You would dictate that at 5/100ths of a pound increment, and then declare a protein test as well. These all be based on your milk tickets per 100 pounds. Can be no less than 2.75 and no more than 4 1/2, also in 5/100ths of a pound. And the other solids test is fixed at 5.7 pounds per 100 pounds of milk. So those are all locked in. That's locked in, but you would pick, basically, potential on price of butterfat and protein. We break that out. I won't go through the nuts and bolts on it. We break those down and rebuild it to set a price, which may be higher than just standard class 3 and class 4 price. And here in this case, you can see that the calculated value for butterfat was $12, $6.80 for protein. Other solids, again, is locked at 5.7. So when this particular producer chose 4.8 on butterfat and 4 pounds on protein, and that total component price of $20.57 almost, that could be potentially stronger. Now these charts change a little bit and are available in the Dairy Revenue Handbook, which is available to the public. I'll provide a link at the end of this. So just for causes of loss, because it is an insurance policy and because you will be purchasing it, is only provides that you will only get a payment for the difference between final revenue guarantee and the actual milk revenue. times your share in your protection factor should there be a shortfall. Yields, loss in yields can be caused by natural occurrences in market prices and, well, in the region. During our first training, the general consensus was most of the time it's always going to be prices. I don't know many occurrences, and y'all would know better about Vermont cattle, where yields would naturally come down cow by cow on average. But if in the event that did happen, then it could kick a payment that way instead of price, because it is all dictating revenue. This policy does not insure against death or loss or destruction of dairy cattle, or selling out or anything else. There won't be a payment. You must deliver the milk. In the event of a loss, yes, your crop insurance agent will work with you on things like that. Correct. Yes, but a notice of probable loss will be issued with the expectation of poor prices. If for whatever reason your crop insurance agent does not issue that, but you know your prices are bad, contact them immediately. You must submit a claim to the AIP. That's your approved insurance provider, which is not your agent, but there's only about 20 AIPs in the country, and your agent works for an AIP. Must submit all the required documentation within 60 days following the date of loss or probable loss. Those documents are production worksheets and marketing records, your milk tickets. And your milk marketing is obviously the total amount of milk sold by your operation during the quarterly period. So now we did create, and I have not added this in a line, we did create a small caveat, especially at the start of the pandemic, when a lot of dairies were having to dump milk on the farm, or they were getting to just pouring milk tanks down the drain. Because that milk was made, that milk could be insured, even though it was not sold. That was something that we helped to add, and I'm very proud that we did that. So hopefully we don't ever see times like that again. So just a very, very basic rudimentary example, calculation again, and it's something, I don't know why this is the first time showing up, but you must deliver 85% of the milk that you book. So if you book 1 million pounds, you must deliver at least 850,000 pounds of milk in order to be eligible for any payment. If you come in below that, the contract is null. So your guarantee, though, is the value of your milk times the pounds of your milk times your coverage level, which can be between 70 and 95% again. In this example, the producer locked in a price of $20 a hundred and booked on 1 million pounds of milk, and shows really the Cadillac coverage of 95% coverage. So that guarantee equivocates to 190,000 pounds of revenue for the quarter. Now the actual revenue then becomes the actual value of the milk, the actual price, times the actual amount of milk made, plus a yield adjustment factor if you took one. In this case, the producer did take 2% yield adjustment factor. So in this calculation, the price came in at $17 a hundred. He did make his 1 million pounds of milk as stated and delivered. So with a shortfall of $3 on price, the indemnity payment works out to be $16,600. It's pretty much that easy. There's a lot of more sausage in the making, in the background, but that's the essential nuts and bolts of it. Okay. Just a handful of important dates. Contract change date for your insurance agent is April 30th. That would be if you changed an entity or something to that effect. Termination and cancellation dates are June 30th. You must close out by then, or else you might get looped into paying for another year. Always be aware of things like that. The end of insurance period is the final date of the quarterly insurance coverage. Premium billing date is the month following the end of the insurance period. If you booked July, August, September quarter, then you would be billed in October. All of these dates will be found on the actuarial documents, and all of these dates should be provided to you at a time of application. Cancellation during a crop year to submit an application for another DRP policy with a different insurance provider within the same year is not allowed. That had been done previously and is no longer true. A handful of questions we get, depending on how active you are at FSA, and I know a lot of people are, and I believe dairy margin coverage is the newest program they have for dairy. You may participate in both at the same time because they cover two different things. FSA's program covers margins and ours covers revenue. Can you participate in LGM dairy and dairy revenue protection? You can, but not for the same milk. It's probably not advised, but of course, you can do whatever you want. You can have endorsements for the same quarterly period, but whichever policy has the earliest date of endorsement will void out the other. So that's something to be very, very cautious of. And can you purchase multiple quarterly coverage endorsements for the same quarter? Yes, you can. It just cannot be the same milk. But if you wanted to put maybe 100,000 pounds or 500,000 pounds into class price, easy for me to say, class price option or component price option, you could do 500,000 in either and see which might end up paying off and which may not. Now, again, it's an insurance program and it's not a get-rich-quick scheme of any kind. As far as the state of Vermont, this is pulled directly from our public website. In 4 years now, Vermont has been very active, really, in DRP. It's not a surprise in a first-year rollout of 2019 to be a little slow. 2020, obviously, we had a lot of issues. We had a pandemic, had a high loss ratio there of 3. So overall, a little over $3 million in indemnity payments were paid to Vermont dairies that were enrolled in DRP on only $1 million premium, of which $448,000 was subsidized. So out of actual producers' pockets, somewhere around $554,000 came out of y'all's pocket, and it netted $3.1 million in indemnity payments. That number got reversed in 2021. Pretty decent year, better prices, a lot more milk got booked, did have more policies indemnified, but they must have been smaller because not very large indemnity payments. So 2022 is a little early yet. Of course, prices are pretty solid right now. And price most of the time is going to dictate how this goes most of the time. But on average, between 19 and 21, Vermont has had about 25 policies earning premium, total liabilities of about $44 million on average, and about 1.2 million in indemnity payments coming back out, with a premium of, it's 1.4 million total, but the reality out of the actual pocket is more like 700,500. So at a 0.88 loss ratio, that's right around. RMA is sort of happy to be around a 1-to-1 loss to gain ratio. We're not in the business of being in business. We're being in the business of government. So overall, that it might be something worth taking a look at if you have not ever done it. I can't tell you to take it or not, and I can't sell it to you either. But I'll transition over. I don't have much time left. And LGM, real quickly, is a much older program. It's a plan that provides a protection against market versus feed cost. So in this case, it would be the price of dairy versus the price of feed. You may not use LGM with FSA programs, but you can use DRP with FSA programs. So that's a benefit. Nothing is local. It's all based on CME prices as well. It's based on CME feed costs overall. It takes in factors of, mostly feed corn and meal. It can be tailored to any size farm. It's sold every Thursday when coverage prices are available. It's owned by a company called Farm Risk LLC. And if there's an indemnity, that it'll be the difference of the gross margin guarantee and the actual gross margin. So if the difference in milk price and feed price shrinks, then you would get a payment. We don't do a lot of business in this. Not a lot of people are very excited about it, but it's still available.
Biden just gave a really good.
Can't participate. I think that statement is inaccurate. I need to actually go talk to, this may be terrible. Am I still here? Okay. Premium subsidy is a little bit lower, but it bounces between 18 and 50% depending on the coverage level you buy. It is an 11-month period. It does not insure against cattle death, unexpected decreases in milk production, unexpected increases in feed use, or anticipated or multiple year declines in milk prices or multiple year increases in feed costs. That's just the 11-month block. You can't go into multiple years of losses. We'll roll on. And then very, very briefly, whole farm revenue protection for, heavens, go back. Is available. There is also something called micro farm now, which is capped at a much lower level. If you're more interested in pooling all of your revenue on the farm, or if you have sort of a diversified operation, if you have different types of animals and are getting milk. Okay. All right. I will then sales closing date on that is March 15th. So we are past. If you have any questions about that, let me know, because it's going to be a year before we come back around. I hate to hold anybody else up. These links are live and will work. I was going to run through a cost estimator. Let me just show you something very basic right here. So at 115%, can everybody still see that? Good. In this scenario, $210,000 at 95% coverage would be producer premium would be about $7,388 for actual coverage, which is a lot. But if you wanted to walk that down to 80% coverage of producer premium, that's $1,200 total, which will cover, if it'll get there. Come on. Well, there we are. Here. Producer worksheet. If your expected revenue was booked at $192,000, that's on 1 million pounds of milk. That was this basic. Producer premium at 95% of protection would be $7,388. But at 80%, if it gets there, like I said, was $1,200, $1,271. So you can protect a lot of revenue with not a particularly high price, although, $1,000 is still $1,000. So I totally understand that. We do not sell crop insurance through RMA. Crop insurance agents do that. They are available. I'm running long now, so I guess, does anybody have any questions? And I suppose, please just get in touch with me through that. That's our public email.
Hi, Will, we do have a question in the chat. Or a comment. If you do not make 85% of your declared milk, your contract is not voided, but rather an adjustment is made to your indemnity payment.
Correct. Yeah, my apologies. That is correct. Yes, it'll just be brought down.
And again, I mean, you've given us a great overview of this program. And I appreciate seeing the Vermont statistics to know that there is some good participation. And it sounds like in some cases, there's some pretty significant indemnity payments going out. I would encourage folks with an interest you can check out the RMA website if you'd like some general information. But if you talk to your crop insurance agent, you're going to get the details and they'll work it through on your particular farm. And that's really what you're needing. You need to be able to make all those decisions about the various provisions for your own operation.
Correct. And we're here to help with any questions all the time. Well, every workday. So please, if you do have any, yeah, send us an email, give me a call. Good information on our public website. I assume this deck will go out, so the links are active and you can follow them right to everywhere you need to. There's hopefully an agent locator that is working correctly. I've understood that sometimes in the past it doesn't, but it should be working right today. So we do the best we can. I'm going to stop my share.
That's great. Thank you so much. Thanks.
Mhm.
And what I'd like to do is I'm going to go ahead and share my screen. We have one more short presentation. And I'm going to see if I can do a quick share screen this time. I want to go ahead and introduce Bill Ferris is one of the RMA specialists from the Raleigh. And he's going to just give you a couple of quick reminders about some of the new and beginning farmer programs available. And that's what we'll wrap up with. Bill, are you still there?
Yeah, I'm here. I'm willing to go, raring to go.
Great,
Take
thank
it,
you.
just make it a short presentation here. Will, could you bring up those tail end slides? I just wanted to go over a little bit about, the navigating of the USDA with the Beginning Farmer Program, and that's the main way is through the Beginning Farmer Program that was established by the 2018 Farm Bill. And we're very active and throughout the United States. We've been in existence for about 2 years now, and we've had a lot of different contacts with a lot of different agencies, and being able to share the programs that the USDA has to offer to new beginning farmers. The next slide, Will. This would be a good website to go to if you want to get some information as to the different coordinators. There's a coordinator and a champion team that is in each state in the United States. In next slide, Will. I'm going through this a little faster than I usually do, but Jill Thomas in Vermont with the FSA office is the coordinator for Vermont. I work in Maine as a coordinator, and then also in North Carolina, and then as a champion in a bunch of other states. But it's mainly the Risk Management Agency, Farm Service Agency, the Natural Resource Conservation Service, and Rural Development working together as a team to make sure that you know of all the different programs and ways that we can assist producers or new producers or old producers get information about our services. Next slide, please. This just kind of gives you the website where you can kind of go in and touch base with us. The main thing is to do it. Next slide, please. And then the next one. And then this will give you all the coordinators in the different states if you get interested in anything. And then I also did want to mentioned something that the dairy revenue, how do you buy it? And like Will said, you have to buy it through an agent. And we want to make sure that you get to, off of this website, you can also get information about the agent locator. And then another question that always came up is, as a beginning or veteran or rancher, am I eligible for additional subsidy under the dairy revenue protection? And the answer is yes. The subsidy for qualifying beginning and farmers provides an additional 10% to the premium subsidy. So again, we really just want you to get a hold of an agent or call us, our office. And I'm based in West Virginia, so a little closer than Will, but still a long ways up. I really appreciate the risk management club for putting this together. Jake, thank you. Now we'll let you have it back.
Well, thank you. Good information and important information. I'll just let folks know, we do have links to the RMA website, including the new and beginning farmer program through the UVM Ag Risk website. So I'm going to just pop that up again so you can see that link. Before we do that though, are there any questions for our presenters? This is one of my favorite slides. So if you have any questions, you can shoot them in the chat and we will try to get to them. If we don't get to them during this session, then I'll make sure that we forward them with your email, if you don't mind, to the various presenters. But I just want to pop up the UVM Ag Risk website, and here it is on your screen right now. If you go to that website, there is information on dairy RP, and also on some other programs and products that are available for ag risk management. And you know that it's not just looking at production risk. You have a variety of risks as a producer on your farm. So we encourage you to browse the site, maybe look at some farmer profiles and see how some of them are actually addressing the risks to their operations. That's all that I have. I want to be respectful of everyone's time. And I appreciate you all coming. I appreciate our presenters, especially taking out your time to give us your information. If you take a look in the chat right now, Kathy has popped up the link to the UVM website for agricultural risk management. And I encourage you to stop by the site, see what you have. That is also the same location that the recording for this will be posted when it's ready to be posted. And if there are no other questions, we're going to let you get on with the rest of your day. Thank you so much, everyone.
Thank you.